Good afternoon, everyone. Thank you so much for being here today. My name is Sophie Zhai, and I'm the Vice President of Business Development at Universal Processing, or UP for short. Universal Processing has been around since 2003. Over the last 22 years, we've grown into a trusted leader in payment industry, serving more than 35,000 merchants nationwide, processing 3.5 billion annually, and handling over 86 million transactions each year. Today, my goal is to help you swipe smarter to understand how credit card processing really works, and to share some practical tools and strategies that can boost your business profitability. Okay, so this is our table of the contents today. We will go through a lot of useful information. Before we dive into how credit card processing works today, let's step back for a moment and look at how we got here. So in 1950s, that's the birth of credit cards. The first modern charge card was the Diners Club card in 1950. It was basically a cardboard card that let business people pay for meals and travel at certain restaurants. Shortly after, American Express and Bank of America followed, with the Bank of America launching the Bank America card in 1958, which later became Visa. As more banks started issuing cards, there needed to be a system to connect them. That's when MasterCharge, later MasterCard, was formed. The idea of a card network where issuers, acquirers, and merchants could all communicate was born. It's around the 1960s and 1970s. That's the standardization and networks. And in the 1980s, the technology grew very fast. Magnetic stripe technology became widespread. ATMs expanded, and merchants started adopting electronic terminals instead of paper slips. This reduced the fraud and sped up transactions. In 1990s, the regulation and the security goes up. By this time, credit cards were everywhere in US, and the US saw the rise of debit cards, new federal regulations, and better fraud prevention systems just came to the market. So between 2000s and 2010s, that is the digital age. Online shopping changed the game. Processors have to adapt to e-commerce, PayPal, and later mobile payments. EMV chip cards became very normal in life. EMV even became mandatory in the US in 2015, helping fight fraud. So today, processing is no longer just about accepting cards. It's about integrated technology, mobile wallets, and smarter systems that can help business not only take payments, but also run more efficiently. So when you swipe, tap, or click to pay today, you are tapping into a system that's been evolving for over 70 years. Knowing that history helps us understand why fees exist, why rules are strict, and why choosing the right process matters more than ever. So let's start from the basics. When a customer swipes, taps, or inserts a card, what happens behind the scenes? So when you go to a store, for example, a coffee shop, the transaction will go from the POS system to the payment processor. That's the company like us. For example, I'm using the Apple Watch. I will use the NFC just to get my watch closer to the POS system, and it will sense the signal and then send the information to the backend, which is the payment processor. And the processor, like us, will communicate with the card network: Visa, Master, Amex, and Discover. Those are the four main card networks in US. In different countries may have different card networks. In US, those are the 4 main networks. And then the card networks, they will check with the issuer bank, your customer's bank. For example, I get a credit card from Chase, and then Chase will give a response to Visa. Say, oh, do I have enough money? Do I have enough credits for consumers to use for this transaction, for the coffee, like $8? So the card network checks with the issuer bank. The issuer bank will either approve or decline the transaction based on different circumstances. So finally, the funds will settle into your merchant bank account. That will finish the card transaction from the consumer's bank, transfer to the business bank account. So behind this seemingly simple swipe, multiple players are involved. The cardholder, the merchant, the processor, the merchant's bank, and the card issuer. Understand this chain is key to understanding where your money goes. Even though you swipe card, maybe it's just 1 second or 2 seconds, but in the back end, there are so many participants in this transaction. So each transaction will go through all the key players in those few seconds. So the internet, before 5 years before, people can use internet or phone cable. Now most of the credit card machines, they're using Wi-Fi or internet cable to let the signals go through from the POS system to the payment processor, card network, issuer bank, and also in the end, finish the transaction. And then let's try to understand everyone's favorite subject, fees. There are 3 main types of the fees. First is the interchange plus fees. It's set by the card networks. Second is the assessment fees, also set by networks. Then it's processors markup, which vary depending on who you partner with. Now let's zoom in one of the most important parts of the credit card process, interchange fees. So interchange fees are the basic cost that merchants pay every time a customer uses a credit card or debit card. They are set by the card networks, Visa, Master, Discover, and Amex. It's not by your processor. So whenever you get a credit card from the bank or somewhere else, for example, Amazon, Whole Foods, or Costco, they also issue the bank cards. When the card was generated by the issuer, the interchange fees has been fixed for that certain card types. So these fees, the interchange plus fees, will go primarily to the card issuing banks. For example, if your customer is using a Chase Visa card, a large part of the fees goes back to Chase, since they are the bank taking on the risk of lending the money and handling the fraud protections. You can also think in another way. So you apply a credit card from Chase and you enjoy the benefits of using the credit card. It can be cashback, it can be like flights. Sometimes you can use the points for the flights booking. A lot of benefits Chase provided you. Actually, someone has to pay the fees. That is how the card issuing banks make it available for the card holders to encourage them to use credit card to consume. Interchange rates, they vary based on different things. First is card types. The card I just mentioned, like the Costco card, credit card, or Amazon Whole Foods credit cards, they are called rewards cards. So rewards cards, they have very, very high rates on interchange plus because they really give very high rewards for the card holders. And also the business cards. Sometimes people have the debit cards or credit cards, but they also belong to business account with under a corporation or LLC. Those are business cards or private cards. So all different card types will decide the interchange rates. Transaction types also will have effect on interchange rates. So in-person swipes or chip insertions cost less than online or manually enter the transaction because card-present transactions are less risky. As we know, a lot of times when we use our card, we can insert the chip inside the machine, and the machine will give a feedback immediately if it's approved or declined. So that is because we have the card in front of us. This is less risky. But for the card unpresent transactions, for example, you're shopping online, those type of transactions, you can use any cards. If I lost my wallet on the street, some people, they pick up my wallet and they got card number, expiration date. They can use the card information to shop online. That is very easy to be a fraud transaction. That's why, so the rate is closely related to the risk. Higher risky, it will go to higher fees. So for those type of cards swipe in person, the business will get benefits from it. So also the interchange rates vary based on merchant category. So the same card, if you use the card in grocery stores, gas station, restaurants, retail, or e-commerce, they all have different assigned rates. Those assigned rates were generated when the card was generated from the issuing bank. If a customer buys a 100 meal at a restaurant using a rewards credit card, the interchange fee might be around the 1.65% plus 10 cents. That means $1.75 of that transaction automatically goes to the cardholder's bank. Why do they exist? Think of interchange fees as covering three things. Risk is the first thing. Second, infrastructure. Third, reward program. So banks, they take the risk of lending money every time someone pays with credit. Networks and banks maintain the secure systems that move billions of dollars daily. Rewards programs, those cashbacks and airline points your customer can earn, they are funded by interchange fees paid by merchants. So your processor, actually they don't control the interchange. It's set by the networks, which are Visa, Master, Discover, and Amex. But your processor does control the markup on top of the interchange. We call it interchange plus. We will talk about it later. That is the pricing model. That's why it's crucial to understand your pricing model and look for transparency. We just talked about interchange, that's one part. Then let's talk about the second part of the fees, assessment. Assessment fees are charged directly by the card networks, simply for the privilege of using their brand and the network. So I mentioned the network's name a few times. Visa, MasterCard, American Express, and Discover. They are the four main card networks. Unlike the interchange, which goes to the issuing bank, assessment fees go straight to the card networks themselves. They are usually a small percentage of each transaction, plus sometimes a per item fee. For example, Visa typically charge around 0.13% of the transaction amount. MasterCard is usually around 0.125% with some variations. American Express tends to be higher. I guess you might notice that in some business, they have a label. They say Visa Master only, no American Express. Because on a lot of transactions, American Express might be a little bit higher than Visa and MasterCards. For example, on $100 transaction, the assessment fee might be around 13 cents. You can think of assessment fee as the network toll fee. Every time a transaction crosses the Visa or MasterCard highway, you pay a toll. That money helps the network maintain its infrastructure, branding, global acceptance, and fraud prevention systems. For some cards you apply for in China, for example, you can also use that card in US because Visa, they are using the same network under Visa. Visa will also charge some cross-border fees for those type of international transactions. So those network toll fees is very necessary to help all the transactions smooth and safe. The assessment fees are non-negotiable. Every merchant pays them. The only part you can really negotiate is your processor's markup on top. So when combined, interchange fees plus assessment fees, that equals to what's often called the wholesale cost of processing. So everything else on your statement, the markups, monthly fees, junk fees, is what you need to pay attention to. Let me give an example to give you a breakdown, a real world breakdown. So if you pay $100 for something, for a purchase, here's roughly how it's split. So $1.65 goes to the East Union Bank as interchange, for example, Chase or Bank of America. So 0.13 goes to Visa as an assessment fee. And then your processor has their markup. That's why it's so important to know which part of your fees are non-negotiable costs of doing the business and which part are markups that you can shop around on. When you switch the processing companies, the most negotiable part is the markup from the processors, not the assessment fee or interchange fees, because they are controlled by Visa, Master, the networks, or the banks. It's non-negotiable. Then let's talk about the pricing models. There are different pricing models. The most traditional and the popular one is called Interchange Plus, which is very transparent and often more cost-effective. In the recent 5 years, there are 3 more pricing models become popular. They are dual pricing, surcharging, and cash discount programs, which can offset your costs when implemented correctly. So let's explain the Interchange Plus pricing model first. Basically, that is very easy to understand. We have covered the interchange and assessment fees. How processors actually bill merchants is using interchange and plus the processor's markup rate. Usually it will include 2 parts. The first is the true wholesale cost, which equals to interchange fees and assessment fees. Second, the processor's markup, a fixed percentage or per transaction fee added on top. So each transaction or each amount of consumption will have 1% charge and 1 fixed amount charge. Let me give you an example. So let's say you process a $100 transaction. The interchange is 1.65. The assessment fee is 0.13. Processor's markup is 15 basis points, which means 0.15% plus 20 cents per transaction. So your total cost will equal to 2.13, and you can see exactly where every penny is going. So compared to the Based on the traditional pricing, there is another pricing. It's called the tiered pricing. And there are few transactions, a few processors, they prefer to use tiered pricing. It's a little bit more complicated than interchange plus. They will categorize different transactions into qualified transactions, mid-qualified, and non-qualified buckets. Those are not very transparent because sometimes the processors, they will decide what type of card will belong to qualified cards, what type of cards will belong to mid-qualified cards. So I don't recommend the tiered pricing. If you negotiate with the processors in the traditional ways, you can ask them, may I use the interchange plus pricing model? It is easier to understand and more transparent. So the business with a higher volume, or those that accept lots of rewards and corporate cards, it often saves the most under the interchange plus pricing model. You can just think of interchange plus like shopping with a receipt. You know exactly how much the product cost the store and how much markup they added. So the other pricing, like tier pricing, on the other hand, is like shopping without a receipt. You just get a lump sum and hope it's fair. Then let's come to the most popular pricing models in the recent 5 years, especially after COVID. Those pricing models become more and more welcome. From the business owners' feedback, they like it better compared to the traditional ways of the pricing model. I will explain a little bit on why. Let me introduce dual pricing first. So dual pricing, the merchants will display two prices for each item. One is for the card payments. The other one is for cash. This is called dual pricing. For example, coffee is listed at $2 for cash and 2.03 for card. Usually, it requires the POS automatically adjust the pricing based on the payment types. So it has pros and cons for this type of a pricing model. Now there are more and more regulations by the networks. For example, Visa, they have different regulations on those card pricing models. It's if you are using dual pricing model, the pros are listed by two things. So it's clear and compliant since both prices are displayed upfront. Customers can feel they are being offered a cash discount rather than penalized for using a card. But the cons are also here. It requires updated the signage and the POS setups. It may confuse customers if not communicated clearly. For example, I have a retail store. They are selling they are the gift shop. So every item, they have a pricing tag on it. If they are using dual pricing, they have to use the dual pricing, the tag gun to have two price on each item. It's a lot of work, but you have to do this. Only with this, you can make it compliant. Clear and compliant is very, very strictly required by Visa, Master, Discover, and Amex, especially with Visa. Visa even sent out the secret shoppers, especially in New York States. It's very strict. They send out the secret shoppers to check if the business really follow the requirements, if they really label the two price, if they clearly label the cash price and card price on each item. If not, Visa will have a fine starting from 1,000 to 5,000. There was even one merchant was fined 10,000 because they didn't follow the dual pricing requirement, display both prices on each item. So if you have a POS system, it will also help with the clarification on the two prices on each item. It's very confusing. Sometimes people say, oh, what's the difference between dual pricing and surcharge? Surcharge actually, it exists much longer than dual pricing. So surcharge program is a fee added only to credit card transaction. Typically, it's 3% to 4%. It depends on the state regulations. Debit cards cannot be surcharged. So different states will have different regulations on surcharge. Not every state will allow surcharge. Be careful, not every state will allow surcharge. So, for example, a restaurant bill is $50. If the customer pays by credit card, the total becomes $51.50. So it will add a fee based on the base. Of course, it's very easy to understand. That's why it exists much longer than dual pricing. So it will pass the processing costs to the cardholder directly. And it works well for business with a high average ticket size. But this type of program has some cons. So first, as I say, not allowed in every state. Some states, they clearly say it's absolutely no for those type of program. Customers also may view it negatively if they feel penalized for using credit. And also it will require the card brand registration and compliant receipts and signage. You have to clarify what is the base, what is the surcharge fees, and what is the total on the receipts. If you don't follow those type of rules, you will get fined not only by the card brands, Visa, Master, Discover, and Amex, you will also fined by the states. I have a merchant who didn't follow the requirements. They got a fine. They got a fine of $500 by the state. Another pricing model is called cash discount program. The merchant lists a higher regular price but offers a discount for cash. For example, the menu lists a burger at $10.40. But if the customer pays with cash, they get it for $10 only. It's framed very positively. Customers can feel, oh, I got rewarded for paying cash. And it's 100% legal in all 50 states. But the tricky thing is, if implemented incorrectly, it can look like a non-compliant surcharge. It may create some headaches if the POS is not properly configured. So what's the difference between POS and credit card processing? The credit card processing, you only use a machine. To the standalone credit card processing, you only need a machine to enter the manually enter the amount and insert card or tap card for the transaction. A POS is where you can manage all the inventories, all the items. For retail, it's inventory. For restaurant, is the items on the menus. So those models are designed to shift the processing costs away from the merchants. It's very, very different from the traditional ways, either the interchange plus or the tiered pricing models. However, compliance matters. The networks like Visa, Master, they have strict rules, and also the states will have some rules. Always we have to work with some processor who set it up very clearly and correctly. We have to make sure the receipts are compliant and you are very well protected. Make sure you understand the pricing model before you cooperate with any processors. So, but I know for most of the business owners, when you review the merchant statement, you just don't read the details of every page. Usually people will only look at effective rates, which means the total fees divided by total processing volume. That tells you the cost of accepting cards. This is the easiest way for you to for you to learn about the processing rates and if you are charged reasonable. Then let's talk about the common mistakes and the hidden costs. Many business owners might fall into the same traps. Not reviewing the statement regularly, leasing equipment instead of buying, they often buy thousands or more over time, believing in zero fees processing promises without reading the fine print. Let's say a lot of business owners, they receive some advertisement. They say, oh, it's zero fees. You can imagine everything has a cost. If the business owner pays zero, that means someone else will pay the fees because the networks, the issuing banks, they have to make money. They have to get the money to pay the cardholders for the rewards, for the airlines points, right? So when they say zero, you have to have a question mark in your mind and ask for the pricing model, like what I just mentioned. If it's zero fees, it must be one of the pricing model we just mentioned. And you have to decide which pricing model you'd like to use. And also what's the percentage the processor charges the customers, charge the cardholders. Also, I also have a case who told me, the business owner told me they didn't pay anything for the equipment. And they just say the previous processor promised him a very advanced equipment. It's Wi-Fi connected, it's Android based, it's very fancy, it looks very fancy, and with zero upfront cost. He said, oh, I can stop the service anytime. But actually, when he called back to the processor, they told him that, oh, you signed a 2-year contract of leasing the equipment. The final amount of leasing the equipment is 3 times of the cost of the equipment. So sometimes the processor will hide some fees under the zero, under the free. Do not trust the free. There's no free items, especially for the fancy terminals. The cost can be very expensive, 500 to 10,000 to 1,000. It could be very expensive. And if you early terminate the lease, you will get a very big amount of money as a penalty. That case I just mentioned, the penalty was $10,000. It was a huge amount. Also, I have some merchants who said, oh, I can switch anytime. My previous processor told me no contract, no early termination fee. They just sign on a paper. They didn't check the documents they signed. They just signed directly. But sometimes the contract, they will put the early termination fee in very, very secret place and say, for example, their early termination fee is based is like 2,000 or 3,000 in that very, very small parts. For example, they send agreement of 8 pages. The early termination fee, they might hide it in a very secret place in the 8 pages full agreement. So you have to read the agreement very carefully. The agreement is also the application where you have to fill out your tax ID, your business information, business phone number, business owner's information, including the social security number, and also the bank information on the application. For that application, you have to be very careful. For the terminal leasing, there might be another agreement or they will be hidden in this agreement. So is the early termination fee. It will be huge. I heard some people got like to charge the 2,000 for early termination. And also there are other hidden costs. For example, the PCI non-compliance penalties, the monthly minimum charge, the early termination fee I told you, and also annual maintenance fees. All those fees are negotiable. Again, all those fees are negotiable with the processor. The assessment fee and the interchange fees are the costs. They are pure costs and non-negotiable. But for those type of fees, it's negotiable. You have to be very careful with those fees on the application. All of this eats into your margins without you realizing it. So let's come to the smart solutions for the small business. First, I encourage you to communicate with processor and say it is no long-term contracts, which means early termination fee is 0. When it's 0, you have much flexibility. That matters a lot. Sometimes the the processor will increase their rates every year, annually, without noticing you. Or they notice you, but they notice you in a very silent way. And your effective rate got increased secretly. So no contract will give you a lot of flexibility. You can switch to another processor if it happens. Also, the transparent pricing, you have to know exactly what you are paying and know the pricing model you are using. By the way, some of my merchants speak Chinese or speak Vietnamese. They are requesting the in-house customer service who can speak the same language. So you can also try to chat with the customer service, the hours, the language side, so you are not stuck waiting long hours when you need help. Also, the tech integration is something you might consider. Some systems that sync with your accounting and the sales tools. For example, people say, oh, I want the system sync with the QuickBooks. Also, I want the system can be integrated with my POS systems. Those are all some tech integration you have to check before you cooperate with the processors. Different type of processors will provide the different type of terminals. The terminals can be standalone terminals or the pin pad, which pin pad can connect it with other POS systems. There are some limitations on integration for certain models, terminal models, and for certain POS softwares. I encourage you to use some cloud-based POS system. So cloud-based systems will let you manage multiple locations and tie directly into the QuickBooks or other softwares. It's so popular in recent years. A lot of business owners say, oh, I want to check the business every day, but I still want to learn about what's the revenue, what's the volume every day. Use the cloud-based POS system can make it happen. And you can remotely, even you are resting at home, you can remotely manage multiple locations immediately. Also, some mobile payments like tap to pay or QR code payment, which are growing very fast and improve customer convenience. Some people like taxi drivers. I'm not sure if you have that experience. 2 months ago, I went to Vegas and I took a taxi. The taxi driver just when I want to pay, he came up with a terminal and he asked me to tap my phone just close to the terminal. Immediately the payment is done. So the mobile payments is very, very popular recently. A lot of devices, our iPhone, it has an NFC function already built in. So the mobile payments can help us with the convenience. And after COVID, everyone cares about the health, cares about less interactions, direct interactions. So mobile payments NFC feature is super convenient. Then let's talk about the chargebacks and fraud preventions. It's a very, very challenging part for those business who can accept the credit cards. A customer they can dispute a charge, and the funds will be put away immediately from the business owner's bank account. For example, if a customer uses credit card or debit card to buy a product or service, the merchant will submit the transaction and the funds settle normal. But the cardholder, they will contact their bank, the issue bank, for example, Chase or Bank of America, and claims a problem with the transaction. The reasons can be different. It can be a fraud. I lost my card. Or they say, oh, the product is not received. Or service is not as described. Or they charge me twice. It's duplicate charge. Some different types of reasons. The issuing bank will review the claim and, if valid, files a chargeback with the card network. The most tricky part is once the cardholder calls their issuing bank, the fund will be pulled immediately from the merchant's, the business owner's bank account. So the merchants, usually they will receive a chargeback notification with a recent code. The notification, a lot of times, it will be mailed to the business location, or it will, all the merchants will get email with the chargeback notification. The recent code will display what's the reason of the chargeback: fraud, or service not as described, product not received, or duplicate charge. So this is the moment most merchants realize, okay, there is a dispute. Merchants can fight back by submitting evidence to prove the transaction was valid. Example of the evidence: the signed receipts, proof of delivery, refund or cancellation policy showing to the customer, or communication records. So in US, there are certain days allow 180 days. So after the transaction was happened, after transaction happened 180 days, the cardholder will have the right to dispute the transaction. If you receive a chargeback notification with a letter or an email, it will show clearly what type of documents you need to provide. Most cases, the signed receipts are very, very important. On the signed receipts, it will show a lot of information: the transaction date, card number, the information of the cardholder's authorization code, and the signature. Those things are very important to try to argue with the issuing bank that, oh, this business, this charge is legit and I need my money back. To receive the money, usually it will take 14 days to 30 days. So the chargeback, the customer will keep the refund. There are two possible outcomes. The customer keeps the refund, the merchant lost the funds, or the merchant wins, the funds are returned. All those outcomes will have to wait a little bit longer than you thought, because we have to wait for both parties, the business owner, the merchant, and the cardholder's response. So if the merchant wins, the cardholder has the right to do the arbitration. So if the dispute continues, the card networks may step in for arbitration. That will be expensive and time-consuming. It's usually, it's avoided, because I heard, for example, take out the business restaurant. One transaction is only $15, but for the arbitration, the processing fee of arbitration is $250 just for filing, for responding to this arbitration. So usually it will be avoided. By the way, on the chargeback letter, usually there will be a deadline of the response. If you miss the deadline, the business the business owner, the merchant, will lose the opportunity to get the money back. So you have to pay attention to the evidence you have to provide and also the deadline of submitting the evidence. It's very important. Okay, so but also some tips I can share with you. You can use AVS and CVV verification on transactions, or provide the great service and clear receipts. This is very important to respond quickly to the disputes, because if you pass the deadline, it will immediately go to the cardholder without any doubt. So AVS means address verification system. When taking online or key-in payments, always ask for the street address and zip code. So your payment processor will automatically check if they match, and you will receive an AVS response code. For CVV, that means card verification value. You can check the 3-digit security code on the bank of the cards. The Visa, Master, Discover, Amex, they all have Amex. They have 4 digits code on the card back. This ensures the buyer has the physical card in hand. Always requires customers to enter the CVV when making online or key-in transaction. It will help you to prevent the chargeback risk. Okay, to wrap up, credit card processing doesn't have to be confusing or expensive. If you understand the flow, know the fees, avoid the common mistakes, and use smart tools, you will not only save money, but also create a smoother experience for your customers. This is Q&A session. Is there anyone has the questions? Okay, great. I have some question here. Let me see. So if I'm buying a terminal instead of leasing it, will the maintenance fee cost be higher? When should I replace it with a new terminal? Well, usually a terminal standalone terminal can last very long. I have some merchants that use the same terminal for 6 years, but no issues. If no issues, you can keep using the terminal until the processor company calling you say, oh, you have to replace it, or it has some I have some issues with the I don't have the internet, I need a Wi-Fi connected, or I need a SIM card connected to the terminal, I want to upgrade it, and you can always contact the processor. But you don't have to use it. You don't have to have a maintenance that regularly. You don't have to. Also, another question. What does POS mean? The POS means you have a hardware and software to manage for a retail store, to manage your inventory, to manage all the transactions. For a restaurant, it means you have all the menus, and the menu, when you place the order on the POS, the kitchen can receive the receipts, and there is a kitchen display will show what items, what dishes are still processing, what dishes are finished, and what are pickup orders, what are takeout orders. Those POS features will be integrated in the system. For example, the Uber Eats or the third-party apps can be also integrated in the POS. Let me see what other questions. What declines a transaction? If the card is a lost card, for example, people say, oh, I lost my card, but someone else pick up the wallet and use the card to do the transaction, it will immediately show on the receipts what's the reason of decline. Every time when you swipe a card, when you make a payment, you will get a receipt. If the transaction is declined, there will be a reason code on the receipt. So you will see what's the reason behind the decline. Okay, so I'm here always to always happy to answer your questions. At Universal Processing, our mission is to empower the business owners like you with transparent pricing, cutting-edge technology, and dedicated support. Thank you for your time today. I'd love to answer any questions you may have. And if you'd like to a free consultation for your business, please feel free to connect with me at Sophie at Let's Go Up, or visit our website, letsgoup.com. Here is a QR code. You can also scan and fill out information. Ask me any questions. Thank you all. Let's swipe smarter and let's grow together. Thank you very much.